Hey everyone, welcome to our next session for the SOFA Summit. I'm really excited to introduce our next speaker. His name is Chris Picciurro with Integrated Financial Group. Chris, how you doing today?
Hey, how are you?
I'm doing great, great. We're excited to have you here again at the SOFA Summit. Chris is a CPA tax guru. He's actually my personal CPA, so I can definitely vouch for him. And one of the big benefits of owning real estate is you get a lot of tax benefits. But as we all know, it's very complicated. Every single person's situation is different. It depends on the asset. It depends on your income and where you are. And there's a lot of different, thoughts out there on what is the best strategy, what's the best path to reduce your taxable burden. And at the end of the day, the way I kind of explain it is if you are going to want to buy and you own rental properties, you need to have a professional like Chris that focuses on clients that own rental portfolios. And that is exactly what Chris is able to do. He's built this company around real estate investors. And I remember the very first time I did the tax planning session with Chris, and I thought in my mind how much in taxes I was going to have to pay. And then when he told me that actual number, how much less it actually was, I remember calling my wife and just cheering for joy. So who knew it? Because that's the goal, right? At the end of the day is how can we keep as much of our appreciation? How can we keep as much of our cash flow as humanly possible and pay the least to the government? So Chris, why don't you take it away?
All right, Mark, thank you so much. It's a truly an honor to be back on the sofa. It's getting so comfy. It's kind of like a recliner now, but I'm excited to talk to you today and share with now the world what we've been doing in our practice. We've developed a proprietary tax planning and strategy system specifically designed for real estate investors, entrepreneurs, and I'm going to walk through some concepts today and talk through some ideas we have for real estate investors. So I'm going to share my screen here and we'll start the fun. So this concept and what our goal is, and then our brand is called Teaching Tax Flow. And what our goal is to legally and ethically reduce the taxes you pay in your lifetime. So what we're going to talk about today is controlling your tax burden. Tax flow is a term that we created. I actually created it when I was out for a run about 5 years ago. And it just means the tax benefit or burden of any of your financial decisions. So how do we control that tax burden? And this is the REI edition, because obviously we're back at the SOFA Summit. I wanted to put something special together for everyone attending. Just a little background. I've just been doing this a long time. I have a passion for real estate. Everyone on our team eats our own cooking. So I'm really excited about this educational platform because I do love teaching. I do love educating. I do love empowering people with knowledge and pouring that into people. So that's just a little bit about myself. And let's get to the agenda. We're going to talk through the definition of tax flow, and we're going to talk through our 3 laws. So tax planning and strategy, people can engage in tax planning and strategy. In most CPAs and tax professionals can provide tax planning and strategy service, but most of them don't have a process. Most of them don't have, and that, similar to in football, not that these are my favorite teams by any means, but Alabama, the New England Patriots, they had a process. They had a system for running the organization that created great results. So we have a proprietary process that we've created that I'm excited to share with you on how to do the tax planning, because people talk, oh, I got to plan, do some tax planning. Well, what does that mean? So let's talk through how it gets done. So I'm going to share these secrets that we've only shared with our client base, with everyone here today. We're going to talk about the 3 laws of tax planning. So these are like our commandments. We have a 4-step process. We're going to talk about what a marginal tax rate is, which is completely different than a tax bracket. Tax brackets, kind of like that rich dad, poor dad, tax brackets, poor dad, marginal tax rates, rich dad. And we're going to talk through part of that 4-step implementation process is diagnosing Now I'm prescribing, diagnosing your tax situation, sitting at home. I'm going to teach you how to self-diagnose. And we use color-coded diagnoses in our teaching tax flow process because they're easy to understand. And then we're going to talk through our IQ test. So let's say you have a strategy. How do we make sure it makes sense to implement? Finally, I'm going to spend the most time on our top 3 strategies for real estate investors. And then I'll have a special something for anyone watching. So teaching tax flow. What is tax flow? I just mentioned the tax burden or benefit of a financial decision. It's really simple. Every financial decision you make has a tax burden or a benefit. It's up to you to determine what that is. And most people, especially start just getting into real estate investing, don't realize that the tax benefits of their investments. And we're going to talk through that. 3 laws of teaching tax flow. So it's very important to understand from a 30,000-foot view what teaching tax flow is all about, which is tax planning and strategy. The first one, cash flow does not equal tax flow. What that means is that we as real estate investors, we focus, and business owners, we focus so much on cash flow. What we should be worried about is tax flow. What is the after-tax cash that you receive, right? Because a property might cash flow a certain amount, especially on your pro formas, but how can you protect that and not give that up to number 2, your involuntary business partners? So taxing agencies are your involuntary business partners. That's a bummer. If you like it or not, the Internal Revenue Service and for your portfolio, potentially the state of Mississippi, because the state of Tennessee, we don't have a personal income tax return unless you form an entity. Now you've just invited another business partner in, which is the state of Tennessee. And I'm sure people watching are invested all over the country. So any taxing authority or taxing agency is your involuntary business partner. That's the bad news. The good news for you is that you have the choice of how to arrange your finances. You get to write your own operating agreement, and you get to structure how much of your net income are you paying to that business partner. And sometimes, how much is your business partner paying you to reward you for action? So just like people that have children or teachers, certain things you do are encouraged, certain things are discouraged. So luckily, if you're watching this, you're involved in real estate or thinking about it, and real estate is one of the very highly encouraged industries in our country based on the tax code and how it's written. Final teaching tax flow law. Your tax return is a verb, not a noun. The word done, D-O-N-E, is a 4-letter word in the teaching tax flow ecosystem. Of course, it's a 4-letter word. We're math people, not English. But if you're in a situation where your tax return is getting, quote, done once a year, that is completely reactive. And in that case, your involuntary business partners, they're deciding the tax you pay, not yourself. You need to take control of your situation and figure out how to control the tax you pay legally and ethically. So our mission, legally and ethically, reduce the tax you pay in your lifetime. So those are the 3 laws. So we kind of talk about, okay, you might say now, this sounds good. Instead of me giving a pile of stuff or trying to sit in TurboTax and enter things or giving things to my accountant, I wanted to start doing some tax planning and strategy, especially being a real estate professional, or not real, I shouldn't say that, real estate investor. Well, in our system, there's a 4-step strategy implementation process. And guess what? People are very impatient, Mark. People want to implement a tax strategy without going through the proper steps that we're going to identify right here to make sure. I can't tell you how many times someone has done something because they heard it online or their friend did it without going through the process of figuring out if that's correct. So the first thing you should do is really analyze and project your current situation. Figure out what your marginal tax rate is. We're going to talk about that next. Once you figure out your marginal tax rate, then you could diagnose yourself. You diagnose yourself in our system based on color, red, green, purple, gold. We're going to talk about that as well. And then after you diagnose, then we prescribe different tax planning strategies. And those tax strategies come with benefits. Some are immediate and some are in the future. And once we diagnose someone, think about it in the doctor, we prescribe something, Then we IQ test it. Now, IQ test is a proprietary process and system that we've developed. It stands for identify strategy, quantify result. And within the IQ test, we have to make sure that whatever strategy that we've prescribed and you feel like makes sense passes our four tests, which is positive tax flow, suitability, liquidity, and comfortability. So to give you an example, if someone is looking to reduce their tax but they don't have a lot of liquid assets to invest, then it's going to be very difficult. So they might not have the liquidity to implement a strategy. The final thing is implement. So once you diagnose, prescribe, then we say, this makes financial sense. This has positive tax flow. This strategy you can afford, you're comfortable with. Then we go into the implementation phase, and some strategies in our system are self-implementing, like an HSA contribution is an example. Some of them you use a tax professional primarily, and then some of them use a third party implementation partner. So some of our ultra advanced tax strategies would include like a 1031 exchange. You're going to have a qualified intermediary. You're going to have potentially mortgage professionals involved. You're going to have tax professionals involved, and that sort of stuff. Let's talk a minute on marginal tax rate, because this is very, very important when we're trying to figure out one of the laws of teaching tax flow and in our system, figuring out your marginal tax rate. It is not your tax bracket. There's a big, big difference. Tax brackets playing checkers, marginal tax rates playing chess. What your marginal tax rate is, the amount of tax you pay. So the amount you pay your involuntary business partner on each additional dollar of income that you recognize, or conversely, the amount of money you save by picking up an additional dollar of tax deduction. So you could be in a 22% tax bracket in a 30% marginal tax rate. Because the marginal tax rate, and I won't read these things to you, but the marginal tax rate factors in all these bullet points below. We have several different tax rates. We have the self-employment tax. We have the Medicare surtax. We have the net investment tax. We have alternative minimum tax. So these are all things, these taxes that kind of pile on. And also, when your income gets to a certain level, there are limitations on credits, like the educational credits, dependent care credits, maybe even deductions like student loan interest. But there are also some tax rates that are beneficial, like long-term capital gains and qualified dividend tax. So just be aware that your marginal tax rate is not your tax bracket. Okay, take a deep breath. We're doing well. You might have to pause this, go grab your tax return, try to figure this stuff out. But so once you know your marginal tax rate and you figure out what you think your marginal tax rate might be in the future. Now, if you have a crystal ball, I want you to email me or send Mark something, because I will like to go to Las Vegas and figure out who's going to win the Super Bowl this year. Of course, I want it to be my Tennessee Titans, but that's another story. But once you figure out in general, like if you're in a peak your earning year and you're a couple of years away from retirement, your marginal tax rate is probably going to be less in the next couple of years than now. But if you're a younger person and your income is growing, and I mean, Mark, what do you think in general tax rates in the future in this country are going to go up or down?
Definitely going to go up.
Right. So let's consider that. So if you think your marginal tax rate is going to be higher in the future, that'll affect what your diagnosis is. So it's diagnose, prescribe, IQ test. So diagnose. So anyone in general who has a 25% or higher marginal tax rate is typically what we call a red diagnosis, meaning they could benefit from an immediate tax deduction. Or if their marginal tax rate, if let's say they're in the 24% marginal tax bracket, but they think they're going to be in the 10% in the future, then they could benefit from red. So red means immediate tax deduction. Green in general means go. Green means that, hey, I'm in a lower marginal tax bracket right now. Maybe I should take advantage of some tax strategies to accelerate income into a given year. Purple's tax deferral, and then gold is tax-free income and growth. And almost everyone should be considering the gold diagnosis. Tax-free income and growth is so important in understanding the difference between tax deferred and tax-free. I'll give you a quick example of a green. Let's say you have a business and you bought a bunch of equipment and you're going to have a low income that year because just because you bought equipment. It's in that year you might want to convert any IRAs to a Roth, because now you're accelerating income into that year. So first step, figure out your diagnosis, red, green, purple, gold which is in our process. Diagnose, and we look at different prescriptions. I'm going to go through the three most popular and best tax planning prescriptions or strategies for real estate investors next. But assume you get that prescription, then you go through that 4-part RQ test. So like I said, positive tax flow, suitability. So sometimes you have to be an accredited investor, which I know you guys work with to get into certain investments. So there has to be suitability. You have to be comfortable with the strategy. There might be certain cities or certain investment types, certain industries that you're not comfortable, or maybe your spouse isn't comfortable. And by the way, you also have to have the liquidity to invest in it. So if it's a syndication deal, yeah, maybe there's some tax benefits now, maybe they're in the future, maybe it's suitable, maybe you like it, but you just don't have the liquidity. Maybe you sold something and paid off your house. Now you don't have liquid assets to implement that strategy. So this is our IQ test. Now let's talk through our top 3 strategies for real estate investors. Okay. So we understand you diagnose, you prescribe, you IQ test it, and then you implement. But what are the top 3 for real estate investors right now? Number 1, Section 1031 exchange. So with the Section 1031 exchange, it accomplishes a lot. It accomplishes red, purple, and gold tax strategy. You get an immediate tax deduction because you're not paying tax on the gain from the sale of your property. You're getting purple because you're deferring the tax into the future. And you're getting gold because if you continue to defer, you'll have tax-free income and your beneficiaries can inherit that property and get what's called a step up in cost basis. So the 1031 exchange is very popular right now, especially with the way the market has gone over the last couple of years. Obviously, there are some rules. This is a more advanced tax strategy where you're going to have to use a qualified intermediary. But I do want people to understand that the 1031 exchange is pretty lenient as far as real estate assets. You could sell a single family home and reinvest that potentially into a syndication. You could sell an apartment complex and buy a commercial property. So that is really nice with the 1031 exchange.
Definitely. And for those that are interested, the way the 1031 exchange works, that's if you already own a property and you've owned it for multiple years and that property has appreciated significantly. And instead of just selling it and paying those capital gains to the government, you can actually sell that individual asset. So let's say you have $1 million house in California and it appreciated $500,000. Well, now you can sell that house in California and go buy multiple little houses in Memphis, but drastically increase your cash flow while also deferring those capital gains down the road. And then essentially, let's say 10, 20 years down the road, you want to sell those little houses. Well, you can do another 1031 exchange and just keep basically kicking the can down the road until you pass away. And then it passes on to the heirs. And basically, like Chris said, those cap gains just go away because of the step up basis. Is that correct?
Exactly. And you get to reset your depreciation schedule. So with the 1031, make sure you're working, ask Mark and the team, make sure you're working with a qualified intermediary. There are some rules, but again, when we think about what does the government want us to do? It wants us to reinvest in assets in this country. So it provides the 1031 exchange. So you could, if you sold the property, the California property, you could either pay the state of California and the IRS, your involuntary business partners, a percent of the profit. But if you really don't need that cash and you want to continue to invest, then you can reinvest it tax-free.
Definitely.
The next thing, building a rental portfolio, gold strategy. Now, Mark and I were just talking about this before meeting here. And so many people focus on that red diagnosis, like I need immediate tax deductions right now. Building a rental portfolio is an amazing way to build tax-free income and growth. Especially if you're a high income earner, because if you have dividends or interest at the bank, you're gonna give up 30 to 40% of that money to your involuntary business partners because of the way the income is taxed. We're building a rental portfolio. You're paying tax. Again, back to the tax laws are written to encourage and discourage certain behavior. You're paying tax instead of on your gross income when you're a rental property owner on your net income after the depreciation deduction. So building that rental portfolio is a great goal diagnosis. And I don't want, and this is going to dovetail into the third best strategy, but my third favorite strategy right now. A tax deduction is very valuable, even if you're not using it in the current year. Okay, that's just something to consider. So building that rental portfolio is a great goal diagnosis.
So let's do an example. Let's say you own some stocks and you get a dividend every year. What is your tax burden on that dividend every single year?
Yeah, well, it depends on your marginal tax rate. So and there are special rates for qualified dividends. So if you had owned the stock for more than a year versus not more than a year, but let's just for argument's sake say 25%, with the state. It could be as low as 15, but you're still giving, let's use an example, Mark. Let's say you have $100,000, you get paid a 5% dividend. So $5,000 and you reinvest it. Well, you don't get any deduction for reinvesting those dividends. You're paying tax on that $5,000. Well, look, if it was real estate and you reinvested it, you'd get the 1031 exchange. So that's why real estate's such a tax advantaged industry. Mm-hmm. And you don't get a depreciation deduction. So if you bought the stock for $100,000, you don't get to deduct the cost of that stock until you sell it. Well, with the real estate, you get to deduct the cost of the real estate using depreciation from the beginning. And even if you finance 80% of it, 75% of it, that's cash flow versus tax flow. It doesn't matter if you pay cash for a rental property or if you finance a portion of it, you still get to take the depreciation deduction, assuming that you're not buying it in a self-directed IRA and that sort of stuff. So, but great segue into our third and final top 3 strategies for real estate investor: cost segregation study. Cost segregation study is great for the red diagnosis, meaning I'm looking for an immediate tax deduction, in gold. So let me talk about cost seg study real quickly, and then I'm going to show you actually a sample report today. With the Tax Cuts and Jobs Act of 2017, what happened was, for the first time, real estate, instead of writing, let's use a single family home, instead of writing off the cost of the building portion of your real estate over a 27.5-year period, we can go in and we can pick apart the tangible personal property portion, nice alliteration there, of the real estate and take an immediate deduction, which is called bonus depreciation, for that portion. And the reason that that's important is that now that's deductible year 1. And depending on your status as either a passive investor or real estate professional, there are some rules with short-term rental properties that you should be aware of. But regardless of if you're taking a deduction immediately for that or over the next few years, that's a really nice thing to have, getting that bonus depreciation year 1. And it doesn't matter if you finance a property or pay cash. So instead of deducting that property over 27.5 years, you're front-loading the deduction for a portion of that. Now, to be able to do that, you have to do an IRS-compliant cost segregation study. Now, a lot of times people hear about these things, but it's almost like, man, I've heard about a certain animal, but I've never seen it in the wild. Well, we're going to show you one in the wild here. This right here is a sample cost segregation study report. And what you're seeing is it's a $400,000. This is just a sample, right? A $400,000 property. Okay. And in general, you usually have to write it off over 27.5 years. In this case, the immediate deduction, which is right here where my cursor is, because we were able to reclassify about $104,000 of the asset as to tangible personal property. So the 5, 7, and 15-year asset classes built into that real estate are immediately deductible. So in this case, someone bought this property for $400,000. They may have only put down $80,000. They're getting an immediate deduction of $108,000 in 2022. Massive. That $108,000 deduction, depending on if it's either going to offset your current year income based on your status as a real estate professional or not, or it's going to be considered passive loss, which could still be used to offset passive income or in the future.
Yeah, which I love that right there, because the majority of the investors out there, watching the SOFA Summit, they're not real estate professional status. We can go into the benefits a little bit later if you are REP status. So let's say you're a business owner, a doctor, an engineer, and you bought your first or fifth, rental property, and essentially, and you make more than, because there's the cutoffs of if you make $100,000 or 150. So, and you make over $150,000, and that's you. This is still a massive benefit, because this is how you pay zero tax on the cash flow, right? That right there is massive in that very first year. And then, well, what happens with the leftover depreciation? Well, it just rolls to the next year. So you just look at your net cash flow and then just keep adding the depreciation to it to cancel it out, essentially, right? So you don't have to pay any tax on that this year's cash flow. Well, then you have leftover depreciation, and then you go to the second year, and then the third year, and then the fourth year. And so basically what we did the math, and it's 10 plus years of no tax on your cash flow, which is massive. And this is something that every single investor out there can do, because the cost segregation study is $400, and it's extremely easy, and you can do it from the comfort of your home. So it's definitely something, that we recommend, everyone at least look into, because of course, like Chris said, the whole goal is to, pay the least amount of tax and keep the most amount of money in your pocket. And this is how you do it.
Right. And this is that cash flow doesn't equal tax flow. So let's say in this property is 400,000, you spent, and again, we're going 30,000 foot view, right? You put $100,000 down, and your net cash flow from the $400,000 property is, let's just say it's $600 a month. I'm just making numbers up. Okay. That means that at $600 a month, that's $7,200 a year. If you get a $100,000 deduction, you're not going to pay tax for probably 15 years on any of the, and if
zero tax on the cash flow
on any of your cash flow. And if someone inherits a property, all that depreciation deduction gets wiped away, and they get to set it up for the fair market value in the future. So,
as in they get
again,
they get to do their own cost segregation study once, and because the depreciation schedule resets, right?
Right. And this is more advanced, but if you're in a community, if you're in certain states where you have two spouses, in some states, if one spouse passes away and it's owned jointly, the surviving spouse gets a double step up in basis. They'll at least get a step up for half of it. So again, we got to keep this, but the point is, the teaching tax flow system is going to help you figure out, I'm not saying to implement the cost seg study. Diagnose, prescribe, IQ test, implement. The cost seg study, just because it's not going to provide an immediate tax deduction, it still could pass our tax. If I told you you're going to get 10 to 15 years of tax-free income, especially if you're a high income earner and tax rates are going up, that's very attractive. And if you have other properties that have passive income, because maybe you paid them off, you could offset that. So
definitely. And why don't we dive into the next strategy of, okay, so this is a little bit more advanced, but we have multiple investors that have done this. Let's say that you are the business owner, you are the doctor, the lawyer, engineer, whatever that may be, and your significant other, they don't have an actual, job or own their own business, but they really like real estate. Well, you can have your significant other, take over the real estate business and become a real estate professional and qualify for that REP status. Now, there's a lot of certain regulations and documentation that you have to be able to qualify. But if your spouse is able to qualify for REP status, well, then you can go and buy this, single family home, get $100,000 first year depreciation deduction. And now you can use that deduction against your active income, against your income as a doctor, as an engineer, right? To just lower everything.
Right. Exactly. So if you received let's keep it easy, $100,000 immediate tax deduction, and you're in the 35% marginal tax rate situation, you would reduce your tax burden by $35,000 in this case. If you own, so you really didn't put down 100 grand. You actually only put down 65 grand. So now your ROI is even better. But again, that's the teaching tax flow system, we have a lot of educational, we have a lot of classes, and we empower people, and it'll assist in explaining, how to track your hours for rep status. What is rep status? So I encourage you, that's a great segue to, we have a special QR code just for Sofa Summit folks. If you're watching at home, you can just scan this with your phone. It'll take you to this website, the teachingtaxflow.com with the Sofa Summit Memphis. We're going to have a special introductory offer for anyone who's watched the Sofa Summit. It'll take you to this website right here. And all you have to do is put in your name, email, and phone number, and we will reach out, understanding that you are an attendee of the Sofa Summit, with a special offer to join the Teaching Tax Flow community.
Well, thank you very much for offering that. That's great.
My pleasure. My pleasure. We've enjoyed working with your customers and clients and owners and investors. And this is the opportunity we have to work with as many as possible, and empower them, and also empower the people, their centers of influence.
Love that. Love that. So if you own rental properties, you have to have a CPA that specializes in tax flow, specializes in reducing your tax burden. And I personally think, Chris and his group are some of the best in the entire country. So feel free to contact them. You can have a free consultation. Definitely check out the QR code. They really value education as well. And that's something that, there's a lot going on with the tax code for sure. And so because of that, it's always recommended to talk to a professional. And I think Chris is one of the best. So thank you very much.
Thank you. No, thank you. And yes, I think everyone's going to enjoy the Teaching Tax Flow ecosystem. We are also working with not only our firm, but other CPAs that understand real estate. And I'm excited for people to check that out. And I appreciate you watching. Thank you very much.
All right. Thanks, Chris. And off to our next session. See you soon. Thanks, guys.